Hello, everybody. Welcome. We are excited to have a special guest with us today. And as we're getting into the new year, I thought it would be good to catch up, hear about what's going on out there in the world. And as many of you know, for years, we've partnered with Scharf Investments and had them as part of our portfolios. And I've always enjoyed learning from Scharf. There's been times when some of the names they put in the portfolio have been highly beneficial. And like many portfolio managers, they've had times when that's not the case. But they've always stuck to their discipline. And the longer I'm in this career, the more I value discipline, and especially in portfolios. And so today I'm going to have Eric Lynch join us here. Hello, Eric.
Hi, Matt. Thanks for having me today.
You bet. Happy to have you. And Eric and I go way back. We met when Eric came to see me at Morgan Stanley. It was kind of funny because I'm not really a marketing guy. So you came into Morgan Stanley, I remember, and I'm not a wholesaler. I'm a portfolio manager. I'm working with a company called Scharf, and this is what we do. And the story was that we try to buy stocks at about 30% discount to where we feel that they're worth. We have about around an 18-month holding period, and we aren't looking to overpay ever if we can avoid it. And so over the years, I've seen names, some of the railroad stocks, for instance, come in and out of the portfolio. I've seen, a name like McKesson where you'll own it for a long time, or Berkshire, those kind of things. But if you could just pretend we're back in those days and you're coming in to see me, maybe explain a little bit about Scharf Investments and just give us this is what we do and why we think we're different and that we do this so well. So again, welcome, and let's hear it.
Yeah, thanks, Matt. Well, listen, thank you to any client that's been partnering with Matt and using Scharf for a long time. We really appreciate it. But yeah, it's a great question, Matt. So if we kind of roll back the tape, yeah, we were just a little boutique and still are investment firm. We managed $5 billion. Think about that versus the hundreds of billions and even trillion with some of these large national firms. So we really care about investing. We don't have a sales team. We care about really protecting clients' capital. We look at it as a kind of an approach to investing like the Hippocratic Oath. I've got a lot of family that are doctors. First, do no harm. And
Mm.
so at the security level, Matt, what we're trying to do is say, look, people just need to make a nice capital appreciation return. Obviously, they'd love to make as much as possible, but you don't want to have too much risk, because if you have too much risk, what happens is clients get agitated, they sell, on the lows, buy at the highs, and their returns are much worse than our products or the markets. And so we think that in general, investment teams underestimate how important it is to kind of reduce the range of return outcomes and just give clients what they need, which is a 10, 12% return with a lot less agitation. And to do that, there's kind of what I would argue three ways we affect that. Number one is, we limit our stock selection to businesses that have kind of top 10% low sensitivity to the economy. So these companies, just kind of like you said, McKesson, just the US's largest distributor of drugs. It doesn't really matter what's going on in the economy. They're printing 10% earnings growth. But you got to also buy good companies at great prices, because you get over your skis on valuations. They miss a quarter. They miss something's going on competitively. And they can have a really drastic reduction in what investors are willing to pay for those earnings. So doing those two things is really important. And because it's not easy to find those types of names, because usually they have a premium, we're concentrated. So it's a Buffett kind of orientated value, quality, concentrated portfolio designed to really protect client capital when things are going south.
Yeah. Well, it's buy low, sell high, and I remember I was probably 12 months into my career as a banker, and I read Peter Lynch's book. Walk around the mall, find things that you like, and don't
Yeah.
overpay. And I'm like, well, how do you do that? How do you know? How do you know if you're overpaying? Or Warren Buffett's always saying, don't lose money and remember rule number one. Well, easier said than done. Definitely easier said than done over the years. So let's dive in real quick. I'd love to hear some comments. We talked before we came into the room here a little bit about, last year was all about the Magnificent Seven, and no need to bash them. Obviously, those are good companies, and they have supplied a lot of return over the last year. They gave up a lot of return in 2022. And so I've cautioned clients to say that these are important companies and they do important work, and we need to participate where possible. But we also, you talk about getting over your skis. If there are corrective measures, if interest rates surprise us, lots of things can happen that would surprise to the downside. in those areas too. But what are your thoughts on, why do you think the market's rewarded them so well? And you own Microsoft in the portfolio, which is one of those names. Maybe just a couple comments there.
Yeah, no, yeah, for sure. So just to put it in perspective, right, the Magnificent Seven on average were up 110% in 23. Their earnings were also up nicely, and they were really responsible for the majority of the S&P 500's earnings as well. So a lot of those earnings, though, levers may have been pulled. And so the risks with the Mag 7 are, hey, these are great businesses. You probably want to have some exposure. And in fact, as you said, we do as Microsoft. We can talk about why that is in a second. But a lot of the names are pretty darn expensive. So you look at Tesla, it's 60 times earnings, a business that has seen its gross margins cut in half. They amped up during the pandemic and so accelerated demand. Now they're getting all this competition with EVs and legacy vehicles and hybrids, and so they're discounting their price points, and their gross margins are getting whacked. And that's a problem because you're paying a lot for it. So that shows you the risk. And indeed, Tesla's, it's off, considerably lately. So the problem with these names is you probably want to have exposure, but at 30% of the S&P 500, the market's really crowded into these names. The earnings, the PEs for them are around 35 to 40 times. Tesla's higher. So you got to be very careful about which ones you own going forward. And one thing what I would just kind of say is a lot of we're based in Silicon Valley. We see this just with our own eyes. A lot of those earnings upgrades or expansions that they provided in 23 were off of what I'd call base effect, meaning 22 is pretty bad. They'd overhired in 21, and then 22, things slowed down. Their year-over-year comparisons in 22 versus 21 looked pretty crappy. A lot of these stocks were down 20, 30, 40%. And then heading into 23, they just whacked tens of thousands, as everyone probably saw that in the news. And so their year-over-year margins looked really great. So revenue was good last year, but margins were outstanding because they whacked their workforces.
Yeah.
Obviously, you can't keep doing that.
Yeah, I read somewhere where Microsoft laid off 10 massage therapists that they had on staff. So a little different
Fair
than the
fact. Fair
staffing we have here at PrairieFire, and probably Scharf as well.
That's right. That's right. So Microsoft, we like that one just because we think the sustainability of those revenues going forward are higher. And what I mean by that is the transition to the cloud is still probably in the second or third inning. They are the primary benefit of that. They have a huge cloud business. They're taking share from Amazon. Amazon's a frenemy to too many clients, right? They're competing with their own clients in media and finance, also commerce. Whereas Microsoft's just an arms dealer of IT. So there's a structural advantage with Microsoft, and we're willing to pay up a little bit for that. So that one we like. The other ones we're just worried that the earnings are not sustainable.
Yeah. I mean, it's got some reminiscences, and I don't know what role you were in during the internet boom in the early 2000s. Obviously, in Silicon Valley, you saw a lot of that. But I was listening to the guy yesterday that founded the TED Talks, and how he went through this. I'm a billionaire, and then 3 months later, I have nothing. This for Microsoft, that feels a lot different. That's not the kind of company that you're talking about anymore.
Correct, correct. So, I think the good news is look, there's a host of opportunities in the market right now that look pretty cheap because they just didn't run with the Max 7. And even before the Max 7, this lower for longer interest rate environment that lasted for so long following the financial crisis to get ourselves back on our collective economic feet around the world, that really pushed up the multiples, the valuations of these growth stocks that are generating so much of their perceived value from future profits. And so one of the reasons the Max 7 also ran last year, in addition to generating some great profits generally, was that there's this feeling, obviously, that the Fed would back off pretty quickly on interest rates in 2024, and then that would let the races begin again for some of these stocks that are growth stocks with a lot of profits ostensibly coming in the future.
Yeah. Okay. Well, I'd like to shift gears and talk a little bit about Comcast and Disney. And so, we all know how much that's taking off. There's lots of talks of consolidation. I'm interested that you own both. Now, I don't know all the core businesses of Comcast, but I've read your commentaries about that. And then in November, you doubled up on Disney. And so there's a lot of people saying, will Disney be acquired? You you guys focused a little bit more on maybe some undervaluation in their experience space. Maybe talk about those two names in particular and how you kind of see that landscape playing out here in 2024, 3, 4.
Yeah,
What year is it,
no,
Eric?
great question.
2024, Jan 18. Let's
That's right.
go.
That's the year. Yeah, no, good question because, they're in the news. The dynamic shifts in play within media are interesting. They're fascinating to watch. And that fascination is obviously, also comes with it consternation. And with that comes sentiment risk and reduced kind of multiples on those two stocks. So from a valuation perspective, they kind of triggered our interest because they're typically stocks that trade closer to, 15 to 25 times earnings respectively, closer, let's just say 20. And so about a market multiple, right? You've got kind of an oligopolist on one hand with Comcast. You've got, one of the premium owners and generators of intellectual kind of property within media in the world in Disney. And so, with the S&P 500 trading at 20 times and Comcast trading at 10 and Disney trading at 15, from a valuation perspective, they're very intriguing. So in our opinion, a lot of that risk as they transition from cable to a on-demand streaming kind of business is priced in. Now, just break it down quickly. Comcast really isn't a media play for us. It's a bonus that they have these media assets, but the valuation really pencils out to be primarily centered on broadband IT. So, it's a business that's utility-like, as you can imagine. They're able to increase pricing because they're increasing quality and speed. There's more and more demand. What's happened, Matt, and the stocks finally started working on this thesis last year or so, but for a long time, there was this consternation about the cord cutting, right? People dropping their cable. But what happens is gross margins for Comcast improve because when a customer drops their cable package, yeah, that doesn't look great ostensibly, but they obviously don't cut the cord. They just consume the media over the top on the internet instead, and they still keep Comcast. Oftentimes they upgrade the speed, and so gross margins are higher for that customer for Comcast because they're not paying these increasingly high media costs for the content. So we're like, great, keep on going to transition to pure play broadband Comcast because you're a better business. Now
Mm-hmm.
they own some media assets. There is some concern that they could overpay as there is certainly an arms race and a consolidating kind of scale matters business globally because now, obviously before it was a regional kind of national business and now it's global. You're competing with Amazon and Netflix and Disney and so the good news is your addressable market is expanding from 300 million in the US to 6, 7 billion or 8 billion. That's great. But the bad news is you've got more competition. There's a transition. There's kind of a valley of investments that are being made and a valley of profitability. And companies have to cross that. And that's a good segue to Disney. Disney's going through that right now. And I
Yeah.
can elaborate on that, but I just want to take
Yeah,
a
I know.
break.
I mean, I know I hear on CNBC about, the ESPN thing and just the challenges with the parks. I got in the big fight with Florida, just between PR and all that. But maybe in the midst of that, then it's become an attractive company for some of the, I think you mentioned some of the other revenue streams besides the media.
Yeah, the interesting thing about Disney is it's a sum of the what we call in the business a sum of the parts story, where it's got these disparate parts that are all pretty interesting. And when you add them all together, valuation wise, the price is way up here and the parts are way down here. And so you've got this big gap, and that's a margin of safety, and that's very interesting. And so what are they? Well, number one, it's Disney's, parks, right? And that is responsible for, in our estimation, about 90% of the current valuation in the marketplace. And so for just 10% of Disney's price, you're getting the unbelievable library of content that they have, all the Marvel movies and Star Wars and Pixar and the princesses and the princes and all that other stuff, ESPN, all that stuff for almost free. And so, this consternation that those aren't profitable businesses going forward, great. If you're not pricing in the market, we'll take that bet. And so for us, there could be some cyclicality in the short term if the economy really rolls over hard on the parks. But despite all the negative sentiment in places like Florida, people are still going. There's the parks are still highly profitable, responsible for most of their earnings right now. So you got that. Now, if they can figure out the profitability on over the top streaming, which we think they will, they have massively reduced their content spend. This is the same thing, Matt, that we've seen in other markets around the world. So, for example, China had three major streaming businesses from the big IT giants over there, Baidu and Tencent and Baba, all had an affiliate doing that. They all lost tons of money because they were all spending money willy-nilly on content, and they were unprofitable for a decade. Finally, about 2 years ago, capitalism being what it is, they finally got smart and said, wait, there's only three of us. Let's reduce our content spend. Let's increase our pricing. And guess what? They went from a negative 20% operating margin to 20% margins. I think you're going to see similar kind of market dynamics in the US, maybe not so quickly, but similar, because scale matters. We're concentrating around a few over time. And Disney has already basically signaled that they think they're going to be profitable by next year on their streaming business after this kind of 5-year buildup. That makes sense. Even Netflix is finally, we're based in Los Gatos, California. That's where Netflix is domiciled. Netflix wasn't free cash flow positive, Matt, until like last year. And so you're starting to get some discipline. All that means is Disney looks underpriced given the value of its assets it has. ESPN, it's also a mass class, pristine sports platform. They're going to figure out a way to partner to get the scale that they need. Mm-hmm. So they're talking to NBA, they're talking to NFL, they're talking to Amazon, they're talking to all sorts of very interesting kind of large partners that could globalize the channel and the platform and kind of monetize it.
The interesting thing is, the other day I was driving past a building that used to be a Blockbuster and thought about Netflix, and like you said, they're just turning revenue positive. So here they've gone, to decimate a business. They've created a new one, but now this many years later is when it's finally starting to make money.
Yeah, great point. It gets us back to overpaying for tech. Tech is great, but you do have to differentiate between profitable tech and speculative tech. And it's fine to have both in your portfolio, but you want to be cognizant of how much and understand the risks, right? Netflix has done kind of all over the place. I'd still be a little skeptical about the valuation going forward, to be brutally candid. But yeah, it's a lot better run business than now. But to your point, it took literally 20 years.
Yep. Well, thank you for being here, Eric. Let's wrap things up real quick and just get your thoughts on. I've been showing clients a lot of charts and graphs and explanations around election years and how they impact markets. And my thesis has been that the president doesn't really impact the stock market, despite the fact that they will always take credit for when it goes well and then blame their predecessor if it does poorly. And so, any thoughts on doing anything different in the election year? Or you guys are known for discipline. You think you'll just kind of stick to your guns this year?
Yeah, I think you're right. I think we'd share your thoughts on that, Matt, that it's really a temporary kind of phenomenon, if it does even have any impact. If you look at historical rates of return for the market in election years, it's maybe slightly behind an average year, as there's some consternation, but it's nothing. We're talking about an incremental impact, and it doesn't really mean anything. So yeah, I don't think there's any change. I think the only thing that we're interested in as investors is, what is really the potential for kind of real significant policy change following the election, and how would that impact some of our companies in the portfolio? That we spend a lot more time thinking about, obviously, as investment managers of your clients' money. So, for example, if Republicans were to run the table and get full control of the Senate, the House, and the presidency, you might have an increased chance that they extend the Trump tax cuts from 18. So that could impact things. Would a particular presidency have more impact on some of our healthcare names, for example, in healthcare policy? We look at that closely, but even those, honestly, it's the reason why we buy these high quality businesses at cheap prices is you don't really truly know what's going to happen. And so you want to buy these things with a big discount, good quality businesses that are going to do well, independent of the economy, independent of politics.
Love it. Yep, absolutely. So safety first. Approach it in life and business and all things. So yeah.
That's right. That's right.
Well, hey, It was great to catch up, Eric. Great to see you. Appreciate the work that you do and all the resources you share with us here at PrairieFire and the support you've
Our
given
pleasure.
our clients through the years. And we'll be interested to check back in this year and see how things go. And hopefully, no geopolitical massive upset, election upset, interest rate. Well, there'll be surprises. There always are. But having a
Count on it.
margin of safety helps protect us, right?
Yeah, absolutely. Yep, count on it.
Right on.
Well, thank you, Matt. Appreciate
You
it.
bet. All right. Thanks, everybody. I hope you have a great weekend. If you're here in Iowa, stay warm, man. Good luck with that. So, all right.
Seriously.
Take care.
Bye-bye.
Thanks.